topic several times, but still a lot of clients and audience would like to ask in details. So yeah, I would like to have a brief point in here, brief all the points in here. So if you would like to use the fixed rate and not using the actual cost of your from your working from your home, so you can use the fixed rate. It can save you time to make the calculation. You can get £6 per week or £26 per month from as your use of home expenses and claim back from HMRC straight away. Or the company can give it to you and they can help you to claim it back to deduct the corporation tax. And if you want to claim more, you can use the real cost deduction, as I said, which need to calculate the actual proportion of the business use. Or if you have any, if you want to argue with the HMRC, you can say that you can use the incremental cost, which is very, very pursuable for the HMRC to accept that this is a real business usage. Another way is maybe more effective is you rent one of your room to the company, and you can claim more, because the way you can claim the real cost deduct as the business use expenses from your company, it cannot include the for example, your rent cost. You cannot claim the council tax. You cannot claim back the water usage. But the story will be different if you rent your home to a company to use as an office or working place, because all the expenses, as I mentioned above, you could include it into the contract. But the problem is you rent a space to the company, the income from your company, you have to include it into your self-assessment and report it to HMRC. And the rent charge to the company should be just and reasonable basis. For example, if you rent a home and you want to sub-rent the room to your company as your working place, the reasonable will be based on the marketing value. You cannot charge an unreasonable amount. You know what I mean? And it is better for you to prepare the board minutes and the rental agreements and to make everything clear, just in case HMRC asked. And also, if you would like to, if you have some rental income, you want to split the income between you and your spouse, and equally, you can use the Form 17 to split the income based on the percentage you and your spouse really want. Yeah. Another tips for you can use for your family members involved into the business is the alphabet shares. So first, you can, if you want to withdraw more money from your company by involving any other family members, for example, your partners or your children, etc., you can give the shares to them. And I would like to say, it is better for you to alphabet the shares, means that, for example, you are the shareholder of the company and you are entitled with the ordinary shares. And if your spouse are in the same class of the shares with you, you have to split the profit by the exactly percentage based on the class of the shares. For example, you're entitled with shares 80% and your spouse entitled with 20%, and your profit is £100, let's say. So you split the dividend by the certain percentage, 80% and 20%, means that you have to withdraw £80, and your family member only can get £20, no existence amount. But this problem can be solved by alphabet shares, means that you are issued different class of the shares. You are entitled with ordinary class A, and your family members are entitled with ordinary class B. Because as long as it's a different class of shares, you do not have to calculate it by the split of the shares by the exact same percentage and the same ratio, it is more flexible for you to planning your dividend and withdraw more money from your company, because different class of the shares are entitled different way to draw without the dividends. It all can be set up by yourself as a director or the major shareholder. And again, 2,000 tax-free dividends you can withdraw for each family members, which is a very good benefit. And oh yes, and there is no when you transfer these shares to your partner, there's no capital gain tax subjected to this transaction as long as you are married or they are your civil partnership. But there is one problem you need to aware with. Is the spouse supposed to be entitled some small amount of the income separate from only dividend withdrawal? Otherwise, it will trigger the bounteous arrangement from the H1C, because H1C might doubt that you're purposely willing to withdraw more from only from the dividend to avoid the real tax liability. And the claiming child benefits, and you need to make sure that both you and your partnership the income below 50K, otherwise you will start losing out your child benefits. And pension. So the company can make the contribution for employee or the directors for pension in their pension pot, and each of the employee or directors have a 40K allowance per annum to let the company to use to deduct their corporation tax liability. Means that any pension contribution from the employer can be tax deductible. And you have to make sure that, again, the deductible amount will be wholly and exclusively. For example, if you have family members or any other members who has no related to this business, and the company contributes the pension pot, contribute to their pension pot, it is not wholly and exclusive expenses, so it is not deductible as expense. It really makes sense, right? And there are two ways you can make the contribute to your pension pot. The first is the salary sacrifice, which contributes from the company and which is the most recommended from DNS, because first, the company can set it up by the account by itself, and it can use this the money in the pot, invest into the commercial property, or loan the money back to the company. You can say it is more flexible and gives you more control how you want to invest your money, rather than letting others to do so. Otherwise, there is a personal contribution. You can make the pension contribution all by yourself, and not and you can withdraw up to 25% lump sum tax free at when your age is 55. And I think, if I haven't remembered wrong, the age will be increased to 58 to in the year 2028. Yeah. And also, you're not only can contribute the pension to yourself, but also to your family members. So let's say up to 2,880, you can contribute to your family members, even though they have no income at all. And then the government will top up 25% to make your family member receive in a total 3,600 in the pension pot in their pension pot per annum. So this is the way you can use to make more pension contribution to your family members. Okay, the next one will be the company cars. You can only get more benefits if the company car is electric cars or any environment-friendly cars. So as long as it is a new and unused car with a CO2 emission 0 gram per kilometer, or electric car straight away. So you can offset the entire cost of the car for the company profits in the first year. It's a first year allowance. And for the electric cars, the benefit in kind charge means that if you are as a doctor who would like to use the company cars, um, it will be have different rates in different year. Let's say, for example, you buy a car with the car's is an electric car, and it costs £100,000, and the taxable value access for the benefit in kind means that equivalent income for the doctor for using the company cars is 1% for this tax year. Means with the total value of 100,000 car, you will be charged a benefit in kind 1,000 for the whole year. Or from next year will be 2%. Means that from the next year, 2,000 top for the benefit in kind if you are a doctor who likes to use the company car. And it doesn't matter if you are a higher taxpayer or basic taxpayer, this 2% is the top. So yeah. So this is all the tax planning for the value extraction. So next week, we're going to talk about more about the tax relief. If you have any questions, I'll go through it and answer it for you. Or if you would like to talk to me privately or want to use us, our team to help you to apply for some tax relief scheme, you can send me the email young@dnsaccountant.co.uk. Sorry, .co.uk.